So what do you do when you have a covered call position and your call option is deep, like way deep in the money, and you are coming up on expiration? Guys, I'm a huge believer in learning from other people's mistakes, but sometimes you just have to take it on the chin yourself, learn from your own mistakes, and in situations like this, allow you guys to learn from my mistakes and hopefully not repeat them. In this video, guys, we're gonna walk through from beginning to end exactly what happened with my Starbucks covered call and my dividend portfolio. We're gonna look at all the income I earned along the way, what situation I'm in right now, and potential resolution options for me moving forward. I don't want to waste a single moment of your time, so let's dive right into the content. All right, so I have a Starbucks covered call position. I own 100 shares of Starbucks, and I have a call option that I sold against that position. We're here in my Fidelity account, and here's the Starbucks position. You'll notice that the current price per share is $86.88 per share. I've got 100 shares, as you can see right here. And I have my covered call position right here. It's a call option with an $80 strike price, which expires August 5th. Current value on that option is $7 per share, and my cost basis for this option is $4.39. I started my position with Starbucks by selling a cash secured put, meaning I had enough cash to buy 100 shares of Starbucks, and I decided to sell a put option obligating me to buy 100 shares at whatever strike price I sell the put option at. So let's understand first what was happening with Starbucks at the time I sold this option. All right, so here's the chart for Starbucks, and this is I sold it on, March 31st. So here's the 28th, 29th, 30th, 31st here. And on this day right here, the high price for the day was $92.63 per share. The low price was $90.97 per share. Now you'll notice here, and it was on this day specifically that I sold a put option with a strike price of $92, okay? And that option was expiring not that same day, but way over here on April 14th. 2 weeks out. This was mistake number one. I don't know what I was thinking. Honestly, as I go back and I think back to this time, I can't recall why I would sell an option so close to the money and with so many days until expiration. I could see maybe selling it that close if it was expiring in the next day or two and I really wanted to own Starbucks and I wanted to just collect a little extra cash and own the shares. But there's really no justification for selling an option 14 days to expiration that close to the money when I could obligate myself with severe downside risk. And as we're gonna see in the chart, something significant did happen. All right, so I sold it here on the 31st and then it went up and I was thinking, woo, this is going great. And then it just took a dump here. There's no better way to say this here. It went from 91 and then all of a sudden 2 or 3 days later here on the 5th, I was down to $86 per share. Okay, the option's still active. It keeps going down even further. This was due to an earnings miss. This is why the price was down so much. 412, 413, we're down here to $80 per share right here. And that's where it ended, right here, $79.50, $80. This is where, right here, I got assigned it. And as we got to this point, I was thinking to myself, maybe I should just continue to roll the option out and hope that the price rebounds for Starbucks. And I'll just, keep waiting. But at the time I was thinking, well, Starbucks is still a good dividend stock. It doesn't have great dividend yield, but the whole point of me selling options on dividend stocks is I don't mind getting assigned because I can hold the stock, collect the dividend, and wait it out. So even though I was significantly down, in my mind, it was better to hold the stock and own it for a while, collect the dividend, and just wait it out, as opposed to continuing to roll that put option out further and further and just kind of locking up my money and not receiving any dividend at all. So it was at this time that I decided to just let myself get assigned, even though I was gonna have a deep loss considering my cost basis, which was the $92 per share, and the price currently at $80 per share. So I let myself get assigned. So we've got my initial put option right here, which by the way, you can see that I collected $184.31 for this option. So you can see right here on the 14th, that was the end of the option, and I invested at that point, because I had cash set aside for this, I was obligated on $9,200 in Starbucks for 100 shares. Okay, so I outlaid $9,200, and then I immediately turned around. It was priced at $80 per share. I went immediately around and sold a 1-month option, right, from April 14th to May 20th with a strike price of 86, which was below my cost basis, but I still collected for that option $103.31. Now, since then, on the 10th of May, about 10 days early from when the option was set to expire, I bought the option back because the price was pretty low still in Starbucks. I bought it back for $5. and I immediately sold another option for $86. Now the price at this point here, let's go over here to May 10th. Let's look back at the chart. So now we go here, remember I sold the option right here for 86, and it was at 81 at the time. And the stock did not do much better right here. Down 426, 49, 430. Here we're into May. We popped up here to 81, and then it took a dump again, which is why I was able to actually buy the option back for only $5, because at the time, right here, the price per share was what, $71.86 against my cost basis of $92. But my option was essentially worthless at that point, so I went ahead, I bought the option back for a significant profit, and I sold a new option for $81 strike price right up here. Again, it was essentially $10 out of the money. And that was for an expiration of May 27th, strike price of $81. And you'll notice here that about 2 weeks later on the 24th, so about 3 days before expiration, I was able to buy that option back for just $2 because, again, price was really low. And at that point, I waited to sell a new option because the markets were red, so I didn't want to sell an option on those days. I did collect my $49 dividend because I was an owner on the ex-dividend date for Starbucks. Now, this was the second mistake here. One of the big reasons why I decided to sell options on Starbucks and allow myself to get assigned was the fact that I was able to collect a dividend. Now, Starbucks doesn't have a big dividend yield. I only collected $49 against an investment of $9,200. So not a great dividend yield, not a good reason to sell an option on a specific stock. I want to like the stock. I want it to have good metrics, but I need to also be thinking more realistically about, do I really want to hold the stock long term if it's got a yield of like 1.5%, maybe 2% at the time? So I collected my $49 dividend, and then I sold another option for $25 here, and that was for a strike price of $82, expiring June 10th. I ended up buying that back 10 days later on the 10th because it was only worth $1 for that option, so I bought it back for $1, sold a new option here with a strike price of $79, okay? $79 right here, and that was set to expire on July 22nd. I sold the option here on June 23rd, okay? Price at the time was $75 per share, and I sold with a strike price of $79 per share, which is what, right around here, okay? Next day, continued to go up in price here. All right, so we fast forward here. Remember, my option right here was gonna be at $79 right here, right? Yeah, right about here. And as the time went along, we got to the 22nd, which is when the option was going to expire right here, and the price was $83.59 per share. At that point, I didn't want to get assigned so low. If I'd gotten assigned there, it was going to be at $79 per share. This means I would have received $7,900 against my initial investment of $9,200. It's going to be a significant loss. I wasn't at that point ready to accept that, thinking maybe Starbucks is just doing a little bit of a rally and maybe they will end up dumping down again. So on the 22nd, the day that the option was set to expire, I went ahead and rolled it. On the 22nd, I rolled out from July 22nd to August 5th, okay? And I rolled up from $79 per share to $80 per share, which was the max I was able to do. Now at the time, my option, which I had sold for $87, was now worth $410. So I went ahead and bought it back and immediately, as part of the roll, sold a new one here. And I received a net credit for that option. I bought it back for $410 and I sold a new one for $439. Again, rolling up and out, up to 80 and out 2 weeks from July 22nd, right here, to August 5th. So here we are today. It is August 4th, right here. Price per share of Starbucks has continued to rally up. We're at $86.88 per share. My cost basis is right here, $80 per share. So I am deep in the money. So we're back in my brokerage account with Fidelity. Here's my Starbucks position, $86.88 per share is the price. So now we're here, deep in the money, covered call. What are my options? Well, let's first off look at the cash flow for this position so far. All right, so I received $184 here. I got assigned for $9,200. Received another $103 for selling a call option. Bought it back for $503. New option for $45. Bought it back for $2. Dividend for $49. Another option sold for $25. Bought it back for $1. Sold a new option for $87. Bought it back, essentially rolled it here. Bought it for $410, sold it for $439, which means my net credit so far in this position, based on cash flow, is plus $515.08. Okay, that's my year-to-date credits. However, if I'm not able to roll this option or make any adjustments, if I do nothing tomorrow, I'm going to get assigned. Okay, unless Starbucks stock just takes a massive drop tomorrow, which I guess it could, but it's probably not going to. I'm going to get assigned probably at $80 per share, which is my strike price, which means I'm going to receive, in exchange for my stock, $8,000, okay? Which when you factor that in, right, factor all the cash flow, my initial outlay of $9,200 out and $8,000 back in, I'm on pace to have a loss overall in the position of $684.92. Let's talk about the different options I have available to me. No pun intended. So I'm deep in the money here. I have a few different things I can do. First thing I can do is, like I said, do nothing. If I do nothing, I'm gonna get assigned, I'm gonna lose my shares of Starbucks, I'm gonna receive $8,000 in exchange, and I have all that cash available to me to make a new position, but I will take a loss of $684. Now, I'm not a huge fan of taking a loss, though there is some benefit to just washing my hands of the position and saying I'm ready to move on to a new investment, even though I'm taking a loss. Now, I could also, second option here, I could look to roll my option again, but at the same time, I'm a little bit concerned about continuing to hold Starbucks and not having a lot of cash flow happening as a result. So let's jump into the Starbucks option chain and see what options are available to me for rolling to a future date and up to a higher cost basis. All right, here's my option. Again, expiring August 5th. Here's my position right here, where the current price is between the bid and ask is $6.80 versus $7 per share. Okay, and here's at the money right here. So if I want to roll this option, I need to get at least $6.80 or $6.90, essentially the difference there between the two. I need to get at least this much money, and I can do it one of two ways. I can do it by extending the date out on the option, or I can go deeper in the money potentially and hope for a Starbucks price going down in value. And I've also got this dividend here, which is a little bit enticing, except it's only $49, right? So if I want to be able to receive this dividend, I need to be the owner of record through August 10th, okay? Because 8/11 is the date that they look at to see who actually owns it. It's a little bit enticing to keep the cash, but I don't think it's going to hold me. So let's go to August 19th and see what options are available to us. Okay, my option is currently valued at $7. If we come out here to the 19th, if I wanted to sell that here, I'd essentially be at the same strike price, $80, and I could get the same price. So I'm extending it 1 week, and I could go ahead and roll to this date, but I think the reality is with this dividend coming up, what's likely to happen if I take that action is regardless, the holder of that option is probably gonna exercise it because it'll be in the money in advance of that ex-dividend date, meaning I just extended the date another week, and at that point I still don't get the dividend and I lose it a week later, which means I lose the opportunity to sell options for a week. I could do that, and I would gain maybe a credit of, I don't know, $10 for doing that, for extending it a whole 2 weeks. And I don't get a higher cost base, which means I'm still gonna result in a loss of what, $12 a share, from 80 for the strike to 92. Let's go out even further. Let's go out to August 26th. Same situation here. I could keep my strike price of $80 per share and hope that Starbucks goes down in value, and I would collect a credit here. I would get probably about $730 here, but I have to buy my initial option back for $700, so I'd gain, what, $30 to do that. But again, I'm only buying myself time for the option to lose value and for the price of Starbucks to go down in value, whereas I haven't been able to change my strike price, though. I'm still at $80 strike to do that. I'd be losing money. I'd be paying more money to go any higher up. Again, my current option is valued at $7 per share, so that's what I'm keeping in mind here, because I want to make sure that I'm getting at least $7 per share. So that's 22 days. Let's go ahead and go out even further. Let's go out to September 9th and see where we're at. All right, September 9th here. This is 36 days from expiration, and I'm still kind of at 80. I could potentially sneak into 81, but I'm still probably paying about $20 or $30 to do that. Whereas I could get probably a $60 or $70 credit for keeping my $80 strike price, but going out to September 9th. If I'm gonna roll the option, not only do I wanna collect some premium to do it, I also kind of wanna move up from 80. I wanna get to like 81, 82, maybe even higher than that, so that my final exercise price is still not a significant loss. Now I could go out further. Let's go out to September 23rd. All right, this is 50 days to expiration, okay? Now I'm able to go to 81, and I might even be able to go 82, but I'm still not being able to move the dial too much here, and I'm locking this option up for another 50 days. So I'll collect the $49 dividend if I do that, and I'll increase my cost basis up to 82, but that's not ideal for me. That's a long time to lock up my option and not collect cash flow. I could potentially be having a new position and selling options for $100 or $200 at a time and make up my cost difference here, rather than hoping that 50 days later the cost of Starbucks isn't, $90 or $100, hoping that it's below 82, which is the best situation I could do, and I would get no credit for doing that. And lastly, I could go out even further. Let's go out to November 18th, but then I'm dealing with earnings again. That's not a good idea. Let's go to October 21st. The earnings was really sunk me the first time. So I could roll out to October 21st, 2022, 78 days. Okay, that's a long time to lock up an option, especially since I like to usually do monthly or even weekly options. My current option has a strike price of 80. I'd be able to roll from 80 up to 82.50, and I would collect a credit for doing that, right? Because my current option is valued at $7 even. I'd collect about 40, we'll call it about $40, $45 to do that. And I'd collect the dividend, most likely, that's going to be paid here in the month of August. But at that point, I'm still locking up my option for another potentially 78 days. And the reality is, most likely, if I were to just get assigned tomorrow, I'd be able to get my 8,000, lick my wounds a little bit, and move on to another stock where I could probably, most likely, start collecting more option premium and make up this difference pretty quickly. And let's think through this. Let's say I roll out to this October 21st, 2022 option, and I'm at 82.50. At that point, I'm trying to figure out what my best case scenario would be here. Would it be that it would end up below $82? I'd still be stuck with Starbucks at a significant loss, and it's still 78 days later, and the only cash I've collected during that time frame is $90. Whereas in reality, I could probably collect 2 to 3, maybe even 4 times that amount of cash with a different stock, and I wouldn't have to worry about just, what's gonna happen with Starbucks. So first option is just to let myself get assigned. Second option here was to roll the option out and just hope for the best. But honestly, I'm really leaning towards just letting myself get assigned at this point. If I was gonna roll out to October or late September, I really would be wanting to move my option strike price from 80 to like 85 or 86 as opposed to 80 to 50 for 78 days. Honestly, the most important thing here is learning how not to put myself in this position again, right? I can't control what the stock market does. I don't know what's gonna happen in the future with certain stock prices. I was just in the wrong place at the wrong time, but the biggest thing was not selling an option so close to the money for such a long time frame with Starbucks, and making sure I lay out a very clear strategy for how I'm gonna exit a position in the future. Hopefully you guys are able to learn from my mistake on this situation and take steps to make sure that you can avoid this type of situation in your own portfolio. Make sure to leave your 2 cents down in the comments below, guys. I love your guys' feedback. Let me know if this video was helpful for you, if you learned something new, and let me know what feedback you have for what strategies you would have used here instead of what I talked about in order to resolve the situation or avoid myself from getting in the position. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.